In this video, we are going to be talking about 3 dividend stocks that I think you might be interested in adding to your watch list. Now, in this situation, there are 4 different key aspects that I'm looking for in a dividend-paying stock. The first is a fully franked or partially franked dividend when possible. However, it isn't always a deal breaker if they don't have that. The second is hopefully some capital growth over a long period of time. The third is some evidence of consistent dividend payments in the past. And the fourth is the hope that these companies will be increasing dividend distributions year on year. It is worth noting here, however, that it would be reasonable not to consider some of these positions suitable for my sort of traditional value-based mentality that I normally talk to you guys about on this channel. But I do think it's important to cover as many investing styles as I can in my videos. At the end of the day, you can never really have too much information about the market. Now, before I get into the video, if you are interested in supporting this channel, feel free to tap that like button and press the subscribe button and notification bell next to it. It really does make a huge difference. Now, keep in mind in times like these, especially through COVID and previously around the GFC, you can sometimes buy into dividend paying companies with a very small margin as to what the buy price would normally be. Now, what's important to remember here is that that can increase the percentage of your dividend payment long term. Now, let's use the Commonwealth Bank as an example here. If you would have purchased the Commonwealth Bank after the GFC at around $25 per share, you would now be receiving roughly a 24% dividend payment on that initial investment, which is obviously a great place to be if you happen to be in at that point. So in that sense, my goal is always not only going to be the 4 points I mentioned before, it's also going to be hopefully trying to buy in at a discount to what I could normally obtain that company for, which will then increase the dividend without the company actually increasing it themselves. And like I said before, generally the easiest way to obtain this type of position is via a market correction or just market downturns in general. So the first stock on this list is one we've never actually spoken about on this channel in the past, and that is Coca-Cola. Now, Coke in Australia here have been paying a moderate dividend now for many years. However, what I really like about Coca-Cola is that they're producing pretty decent figures. Now, when we're talking about fundamental figures here, I mean they're getting over a 10% return on invested capital and 21.7% return on equity. Not only that, they've had a very stable earnings per share over the last 6 to 7 years. Alongside that, they're running a decent amount of cash as well. Now, I mean, I really don't have to explain here in too much detail why I like Coke. I don't think this company's going anywhere, and I mean, generally speaking, most hospitality-based bread and butter companies like this perform reasonably well at this point throughout economic cycles. In saying that, even if Coca-Cola were to remove their dividends, I'm pretty confident in it being a very short-term adjustment and not a permanent removal. Now, this brings me to the next dividend-paying stock on our list, which is one of Australia's thoroughbred, fully franked dividend performers. That company, of course, is JB Hi-Fi. Now, before we get into the figures here, the only problem I have with JB is that they are trading at a little bit of a premium to what we would normally like to discuss on this channel. However, I think in most situations, it is understandable at this point in time because they're doing such a great job at growing. I mean, look at these figures. Revenue that is increased from $3.4 billion to $7 billion in just 6 years, and over the same period, you've got an average return on equity of 32%, which is obviously incredible. Not only that, they're producing a 12% return on invested capital, more commonly known as ROIC. Now, I guess moving on from that, when we want to look at the cash and working capital, it is kind of expected here that they are going to be seeing a little less than what you might assume from a company that is of this size. However, I think for the most part here, that is mainly due to the fact that most of their assets are not fixed and they use a lot of their cash and working capital to keep producing these figures and filling stock requirements. I mean, when you think about it, you've got a company producing the goods like JB, and I think at this point in time, trading sort of 18 times earnings is probably reasonable, all things considered. Now, like I said, it's definitely not a value proposition, but if you are looking for a company to produce fully franked dividends, then these guys might be one for you. Now, before I move on here, when it comes to JB Hi-Fi, it is worth noting that those courageous enough to buy in March this year would have seen an average buy price of $23 with a dividend that fell just under 10%. Obviously, that is an incredible dividend for a company that performs as well as JB Hi-Fi do. So maybe this is one to bring up with your plan or consider adding to your watch list. Now, the third stock here is not actually a single company. I know this is a very popular topic right now when it comes to if we should be investing in banks or not. However, I find it very hard to not believe that they will be excellent dividend paying companies over the next 10 to 20 years. So we've got Commonwealth Bank, ANZ, Westpac, and National Australia Bank. Respectively, these guys are all paying anywhere between sort of 4 and 7% dividends at the moment. So let's use the Commonwealth Bank here as an example. Right now, they are producing roughly a 5.5% dividend yield. Alongside that, they're trading at roughly 15 times earnings and have a 15% return on equity. Now, of course, being a bank, when we talk about return on invested capital, it is quite low, sitting just under 1%. I mean, we all know what the banks are here, and we're not really looking at them to try and get rapid revenue growth over the next 5 or 10 years. In my opinion, that's just not going to happen here in Australia. So like I said, when we're talking about dividend portfolios, I think these guys in general, meaning the big four banks, are going to play a massive role over the next 5 or 10 years in that sector. Now, moving on from that, I guess this all really comes down to your opinion in regards to the banking sector in general. I personally think the margins are going to get much tighter over the next 10 to 20 years. However, generally speaking, in companies like the Commonwealth Bank or possibly the other major Aussie providers, you're probably going to see dividends becoming the bread and butter measuring stick for investors. Also keep in mind that when we look at population growth here in Australia, we are due for roughly 100% increase over the next 50 years. The first to benefit from these types of increases and growth will always be the banks. So it definitely might be worth keeping these guys in mind for your watch list. Now, I am thinking about bringing out dividend videos every single month. I really find this to be a super interesting topic, especially here in Australia. There's just so much to cover. So if I have left a company off this list that you would like to be included in future videos or just to be reviewed in general, please comment below and let me know, and I'll definitely add it onto my list of dividend paying companies that will be reviewed in the future. Now, of course, guys, if you did enjoy this video, please help me out in taming the YouTube algorithm by smashing that like button. And of course, if you're liking the content that I'm producing, please feel free to press the subscribe button and the little notification bell next to it. Anyway, guys, thanks again, and I'll see you in the next episode. Cheers.